Get this show on the road. Good morning, everybody. Welcome. Thank you for joining us today. Just a bit of a formal note before we start. We would like to inform you that this session is being recorded. No private data is being stored, nor will any faces be visible. It will be just the slides, the speakers, and the conversations, but just for your information. The next 35 minutes, we'll spend our time on something that affects every business in this room. And I think that's also why you are here. How to manage your company cash in a bit more intelligent way. Not speculation, not chasing headlines, happens every day, but building a structured risk-aware framework for your SME cash management. So today's topic, cash management tool for SMEs, why and how. We will not do really deep dive sessions, but we'll have a high over practical decision framework, some clear governance guardrails, and we will also map what we show you in the framework also to the actual tools that Vivid provides, including our interest account. Educational in nature, framework first, not product first. And we will not provide you with any investment advice on this call. So please be aware about that one. So what's today's plan? What's the agenda? Let's first dive a bit, sorry, why SMEs need to invest their idle cash. I think very clear, but it's good to set that to also understand the framework. Then we'll dive into what we call the liquidity risk return framework. So how do those topics interact with each other? And also provide you with what we think is a quite straightforward cash bucket segmentation. We'll do these essential governance guardrails before matching these to the right tools. And then after me and Jens have been done talking, we'll also have a 15-minute Q&A. We already received some questions up front, but also during the meeting, you can use the Q&A further on that one. For who is this webinar? Well, you can see it on the screen. Managers, CFO, owners, entrepreneurs, startups, basically everybody that is responsible for some cash management within a company. And it doesn't matter whether you run a bakery, whether you run a consultancy firm. I think this applies to everybody. We organize these type of webinars because in our daily business, we, of course, reach out to our users once in a while, or we get feedback on people using our tools. And some of the questions or issues that they sometimes raise are, hey, we have our cash on a bank account, but we almost get nothing in return. I think we can give you some good other tools to provide you with some return. We also hear that people that if we put it on a bank account, it needs to be on a 3 months, 6 months, 12 months deposit, or even longer. But we need to be able to reach our funds. So liquidity is an issue. Again, something we took to heart. So these are just a few examples why we have this webinar. And if that sounds familiar to you, I think today you're in the right place. So let's go over to a brief introduction of the people you will see during the meeting. So starting with me first, on the left side, Esmond Berkhout, the CEO of Vivid Money BV. I've been in the financial industry basically my entire career. One of those jobs has been former CEO of DEGIRO before it was acquired by Flatex. And I also used to work for the Dutch regulator. So I have both business perspective, but also regulatory lens. So I think that's a good combination. I'm delighted to have Jens with me, Jens Maluck. Jens is the VP Client Impact at Upvest. And Upvest has been a great partner of Vivid for many years already. I think Jens has been pivotal in building Upvest client-facing teams, brings years of strategic experience from the fintech and consulting worlds. But I leave it to Jens to introduce himself a bit further. Jens, over to you.
Yeah, perfect. Thanks a lot, Esmond, for the warm introduction. So I'm at Upvest, VP Client Impact. so responsible for all our client-facing teams. Beforehand, I was VP Operations, built our entire middle and back office operations. So the way you can think about it is, if you buy a stock in the app and click the buy button, a lot of stuff happens in the background to actually make sure that you get the share, and then to service you that you get a dividend and so on. So those are the teams that I built up, and I did that beforehand at Bucks, which some of you from the Netherlands might know. So an Amsterdam-based neo-broker that got acquired by ABN last year. Maybe a little bit about Upvest very shortly. At Upvest, our core goal is to offer a unified, scalable, and very cost-effective investment solution to our partners. So that we build a full custody bank and a broker from the ground up, and fully API-based. So as mentioned by Esmond, we've been partnering with Vivid for many years already. We have a strong relationship, and we're looking forward to strengthening it even further and helping all of you obviously grow your assets with Vivid.
Great, Jens. Thank you for that. Just a small step in between. If you have any questions, like I mentioned before, we do want this to be interactive. Of course, it will be us talking quite a lot, but at the end, we do have some room from Q&A. So we welcome you to raise your questions via the chat. As you can see on the screen, there's a small Q&A button in the bottom. Nikita, who already introduced himself there, will pick those up. We will not be able to maybe answer all the questions, but if not, most of them will be answered after the session has ended, and we will also share the recordings, etc., etc. So please feel free to ask. Jens did already do a small introduction of Upvest. Let me do one of Vivid Money BV as well, just so you know who we are and what we stand for. We're part of the bigger Vivid Money Group. We are based in Amsterdam. Our headquarters are in Berlin already since 2019. So Vivid's been around for 6-7 years already. Recently, we surpassed the 100,000 SME customer base, and we did so under 2 years. Initially, we started with retail, and 2 years ago, we pivoted to serve SME customers, and that's been quite successful since. Also on the Vivid Money BV end, the products we will be discussing with you later today, we tripled our balances within a year, and we also almost tripled our user base. So all good there. Maybe not so relevant for you, but relevant for us nevertheless. We are authorized and regulated as an investment firm. Financial companies need to be. Upvest is regulated, we are regulated, and we are regulated in the Netherlands by the Dutch Authority for the Financial Markets. We have both an investment license, which is under MiFID, for those who know, European regulations that regulate all investment businesses, and also MiCAR, which has recently come into play, which is the European regulation for crypto. So from the BV, we can offer both investment services and crypto services, but a bit more about that later. Vivid is not only based in Berlin or in Amsterdam. We also have hubs in Luxembourg, where our sister company, Vivid Money SA, is located. We also have Limassol in Cyprus, and we keep expanding our services and businesses throughout the EU. I think the next slide is on Upvest. Jens, you can repeat that if you like. You did a small intro already, but maybe you can touch upon it.
Yeah, I'll keep it very short. Funnily enough, similar to the Vivid Group, Upvest is also headquartered in Berlin, and similar to Esmond, I'm based in Amsterdam. But since the beginning of last year, we also have a UK entity to serve the UK market, and just really make sure that our clients can have a unified offering across mainland and the UK. Currently, we have we give access to more than 50 million end users on our platform via different clients. You see some names here, and obviously Vivid as well. We processed more than 100 million trades last year, and as Esmond mentioned, we are regulated by the BaFin in Germany, as well as the FCA in the UK, with all the licenses we need to offer these services.
Yep. So thank you for that, Jens. Now let's get over to why we're actually here, because the rest is all background, important to know, but I think you're here to actually understand what you need to do with some idle cash. So why should you invest your cash at all? You can also leave it like mentioned before, a bank account. I think we all have heard of inflation. If you put it there and you don't generate enough return, your money will slowly but gradually decline in value. So we know and we see many companies hold substantial cash buffers. Yeah, I think putting it on a bank account is not the ideal world. And of course, if you need some spare cash there, good to do. But I think there's better products around to earn you some interest. And saying so, of course, it's important to also keep liquidity, so to remain to have access to your funds. But that's a bit what Jens will touch upon later as well. I think it's also good to be able to have easy products. So not really complicated in opening up an account or setting up the structure or being losing a lot of time on a daily basis to manage your products there. So I think that is something that we keep in mind when we develop our products. But we'll touch upon that later. Then let's first start with the definition, because I've used the word idle cash a couple of times already. Let's first try to agree on what we mean, at least with that one. Because idle cash is not all your cash that you have. So you have cash that you need for daily business. You need to pay your invoices. You need to, I don't know, do some groceries, etc., etc. So not all your cash is idle cash. The way we see it is we basically see three different buckets. We show them on the screen. We have operating cash, we have reserves, and we have strategic cash. Operating cash is what we mean with everything that you need in the upcoming 60 days. Think about payroll. So you need to pay your employees on a full weekly or a monthly basis. You need to pay taxes. I know, not a big fan of that as well, but we have to do it. You have to maybe pay suppliers. They also usually have 28 days of paying possibilities. So that's all combined within the operating cash bucket in our definition. And what's important there, that if you put it in a product, whether that's a bank account or a deposit or with Vivid, you need to be able to access it instantly. Main focus there should also be capital preservation. So don't speculation, not high yields, etc., etc. Just having it available when you need it. Then we have the reserves, everything up to 6 months as we define it. That's your safety cushion. So for instance, some companies are subject to seasonabilities, summer holidays or Christmas spikes, etc., etc. So when your revenue swings, you need to have a buffer to be able to also survive those months of a bit less revenue. You might have unexpected cost. Can be anything. Your car can break down. Your engine needs to be repaired. That's important for running your business, etc. So there, our priority, at least as we see it, is liquidity, and of course a bit of yield. Don't aim for the stars, but just modest, safe investments. And then, of course, you have your strategic cash. That's anything that is required after 12 months. So not part of your operating pool, not part of your reserves, but really strategic cash. Longer term, runway, planned investments. If you want, I don't know, company takeovers, whatever you have in mind, money that you need to reserve for that one, that is not imminently needed. So liquidity might be a bit less important there because you can plan it, but there needs to be return potential so that you can at least earn money on that one, and you need to have flexibility. So you can decide on what you do, when to do it, when to use it, etc. So with that in the back of our mind, let's go over to sort of the guardrails. I think Jens, I think we're going to you. Sorry about that one.
No, let's do it. No, thanks a lot, Esmond. So what we want to do in this session, give you also some practical questions that you can use to guide yourself. And again, you'll get the recording of this, right? So it's nice if you take notes, but obviously you will get all these questions and all the details as well. So just a couple of questions for you when you start down this journey. As Esmond already mentioned, first assess when the money is needed, right? If you have idle cash, when do you need it and for what? Because usually that answer drives already what you can invest it in. And we'll talk about asset classes a little bit later and the different investment horizons that are important for them. But that should be kind of your starting point, right? Like, do you have cash? What do you need it for? When do you need it? And then kind of bucket that up. Second part is your risk tolerance or loss tolerance, as it's mentioned here. Obviously, the longer you don't need money, the higher risk tolerance can be. If you need it in a couple of months, maybe it's not the best to invest in single asset stocks, where fluctuations could be extremely high. And the last two are a little bit more operational. And I'll talk about the sort of governance and processes in another slide soon. But really think about who approves decisions internally. Right? Investing is one of these things. I don't know if any of you invest privately. It's quite easy sometimes to get tempted by the news, but this is your company cash and not your own cash, right? So you need to really think about who approves the decisions and that you don't fall into normal investing traps with this money. And similar around active management or set and forget, essentially just means, do you want to actively and continuously look at the portfolio and make investment decisions, or would you rather invest it and forget about it and hope that it returns, makes a nice return? Again, based on these answers, different asset classes might be more suitable for you. That we'll get to a little bit later. So looking a little bit to the policy and practical guardrails, right? So what do we mean when we say define an investment policy? I think here it's very important that you, before you start, consciously think about what is it that you actually want to achieve? What products would you feel comfortable with, and what are the limits that you do? Because what you want to avoid is that kind of your risk tolerance slowly increases over time because you get more familiar with instruments, and as I mentioned, you get kind of tempted by what's happening in the market, or you read something, but like, okay, this is a great idea. And then you have a policy in place that kind of protects you a little bit against potential impulses. And obviously a policy can be changed, right? But then it's a conscious choice. So it's really just kind of putting like the basics in place that also everyone in your company, in case many people already, knows how do we invest with money and how do we treat our money. Concentration risk, I think that's quite clear just because everyone knows Tesla and Nvidia, maybe not the best idea to put all your money in one of these stocks. You expose yourself to obviously a lot of fluctuation of that single asset, right? A lot can happen in companies nowadays that influences the price, and you don't want to concentrate your wealth too much in a single asset class, but think about diversification, funds and bonds and these sort of assets that we talk about later. Liquidity minimum, I think I can essentially skip that as one talked quite a lot about that already. Just means be sure when you need the money so that you don't put all your money you need in the short term in very risky assets and then actually have to realize a loss. And it's also good practice to set up regular reviews on your policy, on the portfolio that you have, on the return, and then also report and make sure that everything is compliant. If we go to the next. Yeah, so this is something very interesting that you can just think about sometimes. You always know these triangles where you can optimize two of these things, but not three. It's a little bit similar, right? So for example, liquidity, risk, and return, they're all somewhat tied. But if you think about it, okay, yes, you can probably generate a high return with a risky asset. You could also lose it quite quickly. But you probably by default have relatively low liquidity, right? If you have a high risk asset, that means that there's also a high risk of market fluctuation. So you could be in the negative for a while. If you then need the liquidity, it actually means you need to realize that loss, right? And that is obviously something you don't want to do because now it's counter to what you wanted to do, which is build wealth, right? And avoid essentially losing value through inflation. And now you're in a situation where you actually have to realize a market loss. You can take market losses over time because generally, obviously, if you have longer time, the likelihood that gets evened out is significant, right? Depending on the time horizon. So it's a little bit something to keep in mind when you play with the asset classes and your portfolio that you want to invest in. Next, yeah. And then maybe lastly, there's a couple of other key considerations to keep in the back of your mind because they're outside of your control. right? Everything I just talked about, that's in your control, but these things are somewhat outside of your control. So I think if you look at what we have here, we have inflation, FX exposure, and interest rate risk. I think interest rate and inflation are quite known, of course. So if the ECB, so European Central Bank, changes the central interest rate, that obviously also means that other providers like Vivid or like others can pay out less, right? Because the overall interest rate is anchored centrally. So it is always important that if you look at just at the interest rate, that you know that that can change over time and it's not fixed and guaranteed, unless, there are instruments where you can put your money, for a fixed time of 12 months, 2 years, 3 years, 5 years, and then you get a fixed interest rate. A bit similar to the mortgage. If you look at inflation, we already talked about it, it reduces your buying power over time, right? So if we at the goal inflation of 2%, that means every year, essentially 2% of your buying power of the money is lost. So if you invest in something and you see the big returns of 6, 7% or something, it's always good to think, okay, well, my money also loses value in that time. So the inflation adjusted return is actually then 5%, right? So just for you to kind of really think about these elements all coherently, because it all kind of ties together. FX is probably the most interesting out of this, because you might have seen it yourself. Different currencies give different interest rates, right? So if you think about, for example, in America, I think the interest rate for the US dollar is relatively high compared to the euro right now. So it seems like a good idea to maybe, if you have a good exchange rate, convert some euro into USD and invest it, right? And generally, that is also a good idea. You just need to be mindful that you're exposing yourself also to so-called FX risk or FX exposure, because ultimately you are still operating in euro. So that means you will need to convert these dollars back to euro at some point. If now the underlying exchange rate between the euro and the US dollar changed significantly, like it could of course also go to the better, right? And then you have like double success, but it could also go in the other direction, right? I mean, geopolitical events and lots of other things could also influence the exchange rate between the euro and the US dollar. So it's just also something to keep in mind. It is still something you can do, right? And it can be very lucrative, but there are other risks involved, and the FX exposure is one of those things you should just keep in the back of your mind. And now kind of framing all of that in a positive way, what should you do? Research the asset, right? Only invest in things that you can actually explain. And obviously, we'll tell you a little bit what some of these elements are later, so you can hopefully explain them afterwards already better. But don't just chase blindly after yield. Check out the actual return rate, right? Understand the concept of inflation, FX exposure, and sort of protect yourself and the company just by making a transparent policy that you can adapt over time, but then it always becomes a conscious choice and not sort of a drift where things just happen and they are not actually then the intended consequences that you wanted originally.
Thank Jens. I think a very nice and eloquent explanation of things that people really need to think about. And for sure, those are the things that we also thought about when we design our products, right? So Vivid is in the business of supporting SMEs in running their businesses. So these things are also taken into account. Of course, you still need to do your stuff on your end, like Jens just explained, understand the products and create your policy. But we try to facilitate those products for you as well. So we will now sort of do a couple of slides where we map the things we just discussed, so the buffers, the reserves, the FX, all those type of things, to the products that we have built or the tools that we have created. And generally speaking, this is the sort of overview that you can look through at those products. So at the top, for your operating cash, we have built the interest account. And all those products will be sort of explained in more detail in the following slides, but just high over interest account. It's giving you a return, easy to set up, mainly driven for liquidity and capital preservation, as you can see on the screen. Then if you look at your reserves, you have a bit more time for that, so no need for immediate liquidity. You can build in a bit of risk, like Jens explained. but not too much. We built the product strategies for this one. Strategies, we'll talk about that later as well. It contains of model portfolios, and within the strategies, you can make some decisions about the risk you're willing to take and the yield that comes with it. And then the last one is the treasury product. And treasury product basically gives you full control. It gives the possibility to select, I don't know, stocks, ETFs, everything yourselves, and build your own portfolio, if you would like to call it like that. So these are the three products that we will address in the following slides. First, probably you've seen quite a lot of marketing around this one. We build a product which provides 5% of fixed interest, and 5% is quite a lot. We do that for USD and GBP, of course, because the interest in America and Britain is higher than in the European countries. Europe is around 2% set by the ECB. In Britain and the US, it's more close to 4.5, 4.5. So in doing so, we now offer 5% for 5 months for newly opened USD and GBP accounts, 4% for 4 months for Euro accounts. So just for you to know. So what is the interest account then exactly entail? It's basically a very easy product to set up. It's like Jens mentioned, a set and forget product. Basically, you open it up with a few clicks. You can send money from your account with Vivid Money SA and just leave it to us to make the magic happen. Basically, the good thing of this one is as well that the interest accrues daily. So if you go to your statements, you can see on a daily basis, you can see the interest being added. One of the things we also did is to create the possibility to deposit by SWIFT. So even from an outside bank account, you can directly deposit to the USD and the GBP interest account. That doesn't work for Euro, but it does work for the other two currencies. And of course, if you want to do the review that Jens was talking about, which is important after the fact to see, okay, how are we doing? Do we need to make changes and amend stuff? Or, I don't know, to report into your CEO or any other stakeholder, all the statements that are required are there. So this is just a really easy to use product. But also here, please be aware, USD, GBP are foreign currencies. If your company is run in euros, you expose yourself to FX risks. And so bear that in mind, higher interest. So basically, if you have a USD run business or you have accounts in USD because you pay your suppliers in USD, then it's a perfect product. So just be aware, there's nothing wrong with FX risk as long as you're aware about the risk you're taking. So we did exactly for this reason also build the USD and the GBP. We've seen we're a scale up ourselves. So we talk a lot to other startups in the Berlin environment, in the Amsterdam environment, where quite a lot of startup companies are located. And we see and we hear quite a lot of people saying, hey, but I'm getting funding from US parties, US venture capital companies or fund investors, and they provide me with USD. I also need to pay my bills in USD. I receive my invoices in USD. So why should I every time convert it back to Euro, pay commissions over the conversion? And if I need to pay it, I need to convert it back again. So that's the reason why we created the USD and the GBP to begin with. So basically to facilitate you in a one-stop shop flow, so to speak, where you can actually just send in your USD and take it out later on and send it back to the account where it needs to be. One of the benefits, like I already mentioned in the previous slide, is that the interest rates are significantly higher than in the Euro. So that's why 5% on those two and a bit lower on the Euro. There's a couple of use cases for the interest account. You can go to the next one, Nikita. I already mentioned a couple of them in the beginning. Payroll float. So if you need to pay your salaries to your employees, if you want to set aside VAT payments, usually that's one per quarter, sometimes once per year. It's easy to make a reservation within the interest account. You can open up multiple interest accounts, so you can have accounts for various purposes. And that is a convenient way to just make sure the money is there in the end of the year or in the end of the quarter, and in the meantime, generating some interest. Also for your day-to-day cash needs, if you don't want to keep it in a bank account, you can put it there. It's available instantly. So if you put it in there and you want to take it out, 2 clicks of a button, and it will be back at your Vivid Money SA account, from which you can then pay your invoices if needed. And like I mentioned, for those people or companies that have overseas trading balances, just a waste to convert it into euros. Just leave it in USD, send it to the USD account immediately, and put it to work on that sense. So a couple of different use cases, but this is the product where you say, hey, I need to have it accessible, but I don't want it to be sitting idle, because then, like Jens explained, the inflation will also affect you. Then next to the strategies part. This is a bit more complicated. We try to make it as easy for the companies as we can. So basically, what we did, we built a product that creates up to 5% annual interest rate. Basically, same functionality as interest account, but we added a couple of other products to it. So that's why we call it a model portfolio. And within that model portfolio, we have different risk profiles. So we have a conservative, we have a balanced, and we have a growth portfolio. And those have different compositions. So for instance, the conservative one is still mainly invested in the same product as your uninvested cash is. But we also have 20% in euro corporate bonds and 20% in global high yield bonds, for instance. And as soon as you move to balanced or growth, the portion invested in those bonds will be bigger. So less cash, more into the bonds, and even more into the high yielding bonds. Those products are a bit more risky, still well diversified, spreading the risk. But with the same products, you can, by that means, create different risk levels and therefore also generate different returns. So this is a product which is for those people that actually say, hey, I have the cash buffers that I was referring to before. And yeah, you can just select the risk profile that fits with you, put it in there, and just don't look at it for 3, 4, 5 months, because it will do its work. And these products generally just over time increase in value. The underlying products can, of course, change in value. So like when Jens mentioned, the ECB will change the interest rate, it will affect the value of the portfolio. So that's something that you need to bear in mind. Usually, markets over a longer time increase, but not always, of course. Well, I touched upon this one already. So the composition is made out of these products. So fixed rate cash and 2 BlackRock products, so iShares, which we think are suitable for this. So again, this is the use cases that we also discussed in the interest account. We also have specific use cases for the strategies. If you have been lucky enough to have a funding round, there's money on your account. You don't need it immediately because you will put it to work in the coming months, years, etc. That's especially a nice area to look at this one. In the beginning, I already explained, if you don't need your cash for 3 to 6 months, you can put it here as well. And you can also put it in the interest account. There's nothing wrong with that. But also you can use the strategies for this one. And for a bit bigger companies, if you already have a couple of investments, if you already have some positions there, this product will just help you diversify. Yeah? So in essence, diversification is just spreading out the risk over multiple companies, and that's what this supports as well. So a couple of use cases for these products. And then The final platform I want to talk about is the next one. That's our latest add-on. That's the Treasury platform. We had it available on in our app for a while. We now also released it on web, so you can access it both via your phone but also on your computer. And this is where you have full control. Like I mentioned before, you can manage and build your own portfolio. It consists out of ETFs, I bonds, money market funds, stocks, crypto even. And we'll explain a bit more in the next slides what these products entail. So please bear with us. But this is where you have direct access to the market, so to speak. We have statistics there, we have charts there, we have over 2,000 assets. So it can be a bit overwhelming, but if you feel that you have sufficient knowledge and that you want to be in control yourself and you don't need the money for the longer run, because this is one product that is especially built for the longer term, not for short term, you can put it here. And of course, also here, like with all our products, we provide instant liquidity. So if you want the money to be available, you can sell it. But like Jens already said as well, if you need to sell when the stock is down, you realize a loss. So that's why this product is just better for longer term investments. For those people that don't know what all these products I just mentioned mean, let's touch upon those in the couple next slides. Jens.
Yeah, perfect. Maybe let's stop at the overview still for a second. Yeah. So here are exactly all the asset classes that Esmond just mentioned are available in the Treasury tool, right? And some of them are also already part of the other ones, but in the Treasury one, you can access all of this. So what we've done here is just to provide you the overview. We'll go through each of the asset classes one by one. And you kind of see also below it a bit the time horizon, which instruments might be suitable for what time horizon. Cool. Let's start with bonds. Bonds, as you might know, are also called fixed income, and this is because they essentially give you, similar to an interest rate, a fixed rate of return. Because bonds ultimately are debt instruments. You will have heard government bonds, like Germany is issuing new government bonds or corporate bonds. And that essentially means that governments or companies are collecting money and giving out a bond or a debt certificate saying, hey, I owe you money, and for that, I'll pay you 5% return every year. Now, with classic bonds, you sometimes have a bit of an issue to actually trade them because they have rather high minimum trade amounts. So it could be like 100,000 euros or something to actually get a bond, a government bond or something, right? Which is not super suitable for the everyday investor. And that's why BlackRock came up with I bonds. So I bonds are essentially, think of it similar to an ETF that I'll talk to in a second. They exchange traded. They're very, very liquid. So you can invest into bonds or like debt instruments via this directly on the exchange. And you don't have these high minimums. And you can essentially get the same benefit without having to go, let's say, the classic route. So if we look at, for example, on the next slide, we see an example, just so to make it a bit more practical. Imagine you got 600,000 from your recent round and you don't need that money right now and you know exactly when you need it. You could invest it into three different I bonds, right? So that you could say, okay, we know we need 100,000 in 2026, 227, and then 28, 300K. And that means you can put the money sort of fixed for the different timelines, and then you see and invest it for also the annual return that you get, right? So it's very predictable. You know how much money you will get out of it. You can, of course, do the calculation within just inflation adjustment, but it's very fixed, and therefore it's also called fixed income compared to where we go next, which is ETFs. And for those people that know a little bit more, yes, ETFs can also be bonds, right? And there can be bonds and ETFs. So it's just to make that clear. But when I now go into ETFs, I'm going to focus a little bit more on the stock side. So ETFs are exchange traded funds. And the easiest way to think about it is it's kind of a basket of underlying companies or assets all in one instrument. So for example, you might also have heard of funds before, and we'll talk about it in a second. You have a fund manager and they select kind of the assets that you want to invest in. It's a bit the same with an ETF, just that you don't have to call someone to do this for you, but you can buy it directly on the exchange. And the allocation of that underlying ETF of the fund is very clear. So it's predictable, it's online, there are trackers. So for example, if you buy the S&P 500, as you might have heard, which is the top 500 companies of the American market, what that means is if you invest your 10,000 euros, that gets spread out with a fixed allocation over those 500 companies. So it gives you a great benefit of diversification. You don't have to buy all these 500 companies yourself, right? You spread your risk. And ultimately what you're saying is, okay, I believe in the American economy, and therefore I invest in this, right? So if the American economy does well, the S&P 500 generally goes up and you have return. But if a single company within that fund, like, I don't know, let's say Tesla was not going to do so well for a while, it doesn't have the massive direct impact as if you invest in Tesla directly, because it's evened out by the other 499 companies. So it's a very cost-effective way to essentially spread your risk and invest in different sectors or geographies. What's also very interesting here that might be relevant to some of you, ETFs can also be structured in not just regions like the S&P 500, but also sectors that align with your values. For example, ESG or sustainable energy or cloud computing or AI. So you don't have to find all the AI companies yourself. There are ETFs that focus on investing in AI companies, so you can directly essentially invest into a sector. One thing to look out for, there's obviously some fees involved, and they're called the total expense ratio, or TER. You can find that easily online for every fund, and that's kind of the recurring annual cost that is baked in. So you don't actually notice it, but the more niche you go, the higher that is. That's maybe just something to quickly point out here.
Yes, back to me, Jens. Thank you. A specific type, if you like to call it, Jens already made the complexity, and IBOND is an ETF. ETF is also a fund, to make it easy. Fund are, in essence, like Jens said, a bucket of investments. The difference between a fund and an ETF is that the fund is not exchange traded. So where an ETF is traded on I don't know, Euronext or NYSE, you can do it on a daily basis. Funds usually have limited ways of trading. So once per day, once per 2 days, and you even have funds that only have liquidity once per quarter or even lower, depending on the investment they use. This was before mainly used by institutions, really big houses that had a lot of cash that they wanted to put, like think about pension funds, etc. But it's become more and more common also to allow this on retail and SME platforms like ours. And basically the same applies, like Jens said, to this one. The good thing here is you don't have the fees for what they call the spread, so the difference between ask and bid. That's not what you have in funds. So you see one price, that's what you pay for the product. Technically underlying, it's basically the same. It's being managed by a professional company, and it diversifies. Looking at the time, let's go through some of the next slides a bit quicker. We're almost there, I think. I think we can skip this one, Nikita. Then the stocks. I think everybody knows stocks. This is just a piece of ownership in an individual company. Like we mentioned before, for this one, you need patience. You need to invest and just leave it as is. Some people think they can beat the markets by doing day trading. Fine. If you want to do that, that's of course your prerogative, but it takes a lot of investments in time and understanding to actually see what you're investing in, and how they compare to others. So this is just invest your money, put it aside for a while, and don't touch it. Then we have crypto, the final part, and this is, I think, the most volatile component of all the products that we just touched upon. Maybe a bit scary for some of you because it goes up, it goes down, but we thought it might be a good idea to add it to the platform because there are people that firmly believe in crypto. if you're one of those true believers, then you can use it to invest your cash in. It might be a good add-on if you say, hey, I already have my money in my operational reserves, I have my buffers, I'm willing to take a bit more risk with my long-term cash. Crypto can be one of those diversifying tools. We also have a staking product there, which is sort of similar to an interest account. You put coins in there. Those coins are fixed. You cannot trade them. And because you fix them, they generate return. And in money market funds, that is called yield. And here you get sort of additional pieces of the crypto coin as a reward. Again, the underlying can, in the meantime, move up and move down. So please be aware that you understand the product if you're entering into this one. But crypto is becoming more and more mature. So I think it's a good tool to have it available in the platform as well. Key takeaways. So just wrapping up. These are the products. I'm not going to repeat everything that is on the screen. Basically, what we are trying to bring across is look at the amount of cash you have available, segment it in buckets, and then try to find the tool that matches to your horizon. And just be aware, it's not about maximizing your yield, like we discussed before, but it's optimizing flexibility, it's managing risk, etc., etc. So I hope we brought this across with all the various slides, and the slides will be sent to you, of course, so you can look through them. But this is, I think, a good overview of what we discussed with the products that we built for it. And feel free to do it somewhere else, but this is just something that we wanted to give to you. We also have one final slide on protection, and I think it's important to touch upon this one because I saw some questions coming in during the presentation, but also already before, is that people ask the question, how well is my money protected? If you put your money with a bank, then it will be protected under deposit guarantee scheme, which is a maximum of 100,000 euros. A lot of money, people want that security. We are not a bank, but the good thing is investments are, because they are segregated from our own estate, but also by law, those are protected in full. So if something happens to us, comparable to a bank going bankrupt, if we go bankrupt, the investment will still be there. They will be fully protected for you. They will be handed over to another broker, and you can simply still access your portfolio. So in that sense, and the same applies to the money market fund, the interest account, everything there, the notional amount is fully protected by the setup we use within the investment industry. And to even increase your security a bit further, the uninvested cash part is invested in some highly specialized investment funds. And there's a couple of them around. We have been selecting them also as a requirement by the regulator, which is, I think, important to stress. We selected Fidelity, and Fidelity offers a certain fund range that is suitable for the use of safeguarding. And again, because it's invested, it's fully protected, it's available for you. So no restrictions, like with the deposit guarantee scheme. The money is available to you in full, even if we are no longer there. So I think that is about what we wanted to say. It's already 10 to 12, so we're running out of time a bit. But let's see if we can do one or two questions. So Nikita, I'm not sure, did you have a look at a couple of questions that we might be willing to answer?
Yes, sure. So the first one was about the deposit protection limit, but I think you answered it during the last slide. And also one person is interested about that they are uncomfortable buying or selling without limit. I'm not sure if we have,
Yeah, I completely get this point. So we, at this point in time, only provide market orders, which means that if you click the button, the order will be sent to the exchange and executed at the price there is. We don't have limit orders yet. It is something that we are looking into. and is on our roadmap for development. So I hope maybe in the course of this year we will launch it, but our roadmap is relatively full with a lot of other product releases. So we have to find a way to make this happen. But I completely get it. If you want to be actively engaged in managing these products, you want to set a limit that executes yes or no. For the funds, for the money market funds, for those type of products, it's less relevant because those trade once per day and have a fixed price. But for stocks, for crypto, for ETFs, that's for sure one of the things that we're looking at.
Yes, so the next, we have a couple of questions about the costs in treasury per transaction and on invested capital, as one person put it. Do you want to touch up on that?
Let me see. I see one on tax. That's easy to answer because we're currently building a product with a partner that provides for tax declaration. So that will be released somewhere in April, most probably. So hold on for a month, and then we'll provide you with the answer. We also have a lot of documents, by the way, on tax, which provide you with FIFO or average overviews of your portfolio. From there, you need to take it yourself to your tax advisor, but the product I was just talking about will be bringing this to your tax advisor directly. And then I think the final question I will answer, and then, like I said in the beginning, we will take a look at all the questions and see if we can answer those when we circulate the recordings and etc. I see a question about the tariffs and especially about the money market funds. So there's two ways you can approach money market funds. So you have uninvested cash. Then, like I said, we use the Fidelity Fund. In that one, there is no fees. So you get the net return as the gross return. So that's the 4% fixed interest. And according to your plan after the promo period, so depending on your subscription, it will be a higher or lower interest rate, but that's the interest you get. If you buy the funds yourself, there are, and that is subject, and I would like to refer you to the website for that one. The returns we show are always gross. So because we have various different tariff structures for different plans, it's impossible to show net fees, net returns. So that's why we show gross. So if we show, I don't know, 7%, and you are in one of the free plans, you probably have a bit of a higher service fee. That means you need to deduct the service fee from your gross return to get to the net return, that is. So I hope that one. I think we'll leave it to that for now because we already took 55 minutes of your valuable time. And like we said, we're here to support you in running your business. So I think everybody is eager to run and return to their business as quick as they can. So thank you so much for taking the time to listen to us. Jens, thank you for being here. I'm happy you were here, and I got a lot of comfort listening to you, at least. We will circulate the slides as we discussed before via email. The webinar itself will be circulated at a later moment because we need to do, of course, some touch-ups. And then if you want to have more information about the products for Vivid or from Upvest, there are some QR codes on the screen. They will be in the slides later as well. Please go there and have a look. And again, thank you for your attention, and I hope you have a wonderful rest of the day. Bye.
Thank you. Bye, everyone.
Thank
Bye-bye.
you all. Bye. Have a nice day.
Bye-bye.